Good afternoon and welcome to day 2 of Tales from the Coach. I've been coaching traders here at Topstep for a little over 10 years. We have John Doherty, the Dancing Bear, with us this afternoon to help answer any questions that may pop up in the chat or even the Q&A section. How are you, John?
Hey, Hogue. How are you? Doing great. Welcome, everybody. Welcome to day 2. If you do have some questions, throw them in the, there's a Q&A button down at the bottom of your screen in the Zoom window on that bottom row. Hit the Q&A button, type in your question there. I'm afraid sometimes if you throw them in the chat, they kind of get lost in the shuffle. So you have a better shot of having your question fielded if you throw it in the Q&A section down there. But that's all I got.
Thank you very much, John. All right. Maybe I should turn my camera on for a minute. Hello, everybody. Good to see everyone. All right. So let's get started. This is Tales from the Coach, day 2. We had day 1 on Tuesday. If you were there, hopefully you enjoyed it and found something useful for you to bring along with you in your trading journey. I've been working with traders since 2011 here at Topstep and really kind of accelerated that about 4 or 5 years ago when we started doing the group coaching and some personal coaching. It's something I really enjoy. This is a picture of me and my son when he was 13. We went to Cooperstown Dreams Park, and I was one of his coaches for his baseball team, and was highly active in his football, and really kind of became passionate about coaching at that time. And again, this is always a pleasure for me to present to everybody and hopefully improve performance. I see a few folks here that I see. We had John Manny, new to Topstep. Jenner passed step 1 today. Congratulations. Daniel Frampton, I don't know if there's any relation to Peter, but welcome. And we're going to get started here. So brief introduction of me. My name is John Hoagland. I'm the middle-aged performance coach here at Topstep. 39 years of futures industry experience, not necessarily all of them actively trading, more like 30 years of that. Traded on the floor of the Mercantile Exchange for 20 years and migrated to screen trading in 2009. I had a number of friends that had tried to do that before me, rather unsuccessfully. So I took a whole year and just tried to unlearn and relearn trading from the bottom up, from pit to screen. Since then, I've been trading, and since about 2011, I've been with Topstep. And again, it's one of the joys of my life is hanging out with traders, talking about trading. So we're looking forward to having another good session today. This is the CFTC disclaimer. It states that there's a lot of risk in futures trading. Of course, we're all well aware of that. These are leveraged products, and you can potentially lose more than you have in your account. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. I look at risk capital as money I can afford to lose. You should only use risk capital for trading. One of the reasons I love Topstep is you're not going to have to put up risk capital. Once you're successful in the trading combine, we're going to put up the risk capital for you. We're not going to be buying or selling anything today, so we don't have to worry about that. And of course, there's never any representation that any account or a particular trade is going to make or lose money at any time. The table of contents. Day 1, we went through the first 6 of the most popular questions, and maybe some of the harder questions that I get quite often in group coaching, and even with some of my more personal coaching. And so looking at what we looked at in day 1, why is it so easy to trade on sim and so hard to trade live? What is the opening range, auction process, open interest delta, and organizing that information to something usable? Hopefully, again, you found day 1 helpful. Day 2, a lot of folks get close to their profit targets in the trading combine and find it so difficult to take that final step to finally succeeding and then end up blowing it. We're going to take a look at why that happens. Why are we not wired automatically to succeed in trading? This is a really good and a really popular but tough question. Handling emotion, something we all have to deal with when we put ourselves out there, when we put our money on the line. It can become a highly emotional situation. We're going to take a good deep look in how to handle that. And then finally, how many markets should I trade at once? It may seem kind of strange that this is such a popular question, but with the ease of moving from market to market in electronic trading, this actually comes up quite often. David, you are going to be getting a recording of day one and day two if you registered at all for Tales from the Crypt. All right. Why do I keep getting close to the target and then blow it? This is an actual email from somebody, one of the many people who asked this question. And it reads, I'm having a lot of trouble completing step two, not in terms of game plan and setups. Been trading futures since April of 2021. My issue is I keep getting to $8,000 and then I fumble and blow the account. It happened about 3 or 4 times now. Whoops, hang on. At this point, I know it's psychological, but I really need help knowing what to do about it. Speaking from personal experience, every time I have put a financial or time-based goal in front of me in trading, it has usually come out with tragic results. For example, for a while in the S&P, when trading my own account, I had a 40 tick profit target on a daily basis. So I would trade and trade the morning and think I was doing pretty good, and my clerk would come up to me and he would say, who was well aware of this goal, he would say, hey, you're up 38 ticks. That's good enough. Let's get out of here. And I'd say, nah, I need to reach my goal. Let me make a couple of extra ticks here, and then we'll go. Well, if the next trade is a loss, now you're further away from your goal. Now you're thinking, oh, well, I got to make that back now. So you take the next trade. And if that trade's a loss, you start to get emotional. I have taken days where I was so close to that target, and just because I had to make that target, stepped outside of my strategy just to make those few extra ticks, and ended up blowing up tremendous days to well past the point of losing the 38 ticks that I was up, and ended up having, a terrible day. So, and, there's also the idea that, I've got to hit a profit target. If I have a trade on and I've got 10 ticks of risk and I've got a 30 tick profit target on it, and I'm 28 ticks to the target, I'm within a couple of ticks to the target. If I get the willies, or if I, feel as though it may not make it, I can take that I call it my 10% rule. If I'm within 10% of the profit target, I can take it and call it a full profit target. The point being is, if I were to say in trading that I'm going to make $10,000 this week, I can pretty much guarantee that it's not going to happen, because I'm not going to be taking what the market's giving me. I'm not going to be staying in my process and in my strategy. I'm going to be doing things to try and prove myself right that I could make $10,000 that month or that week or whatever it is. So when you get to a point where you've been to before, you're in step two, you're up to $8,000, and you start to think, all right, tomorrow I'm going to make $1,000 and I'm going to finish step two. That is a dangerous thought. What you should be thinking is, okay, I've been trading well. My process is working. my strategy is working. I'm going to lean into my strategy and my process, not focus on my end goal. Just find the next good trade and take it and take what it gives you. When you relax that way and you take your focus off the end goal, you'll stay closer to your process, closer to your strategy, and you'll probably end up saving yourself money and time in getting to your profit target. One of the things about that, that being up 8 grand and saying I'm gonna make this tomorrow, is you're discounting what the market is capable of giving you. The market may be small tomorrow. The market may really only be capable of giving you $300 as part of your strategy tomorrow. But if you are forcing it and pushing to get to that 1,000, maybe you'll oversize, maybe you'll overtrade. Your goal no longer becomes staying in your process and in your strategy. It becomes reaching that goal at the end of the road there, that rainbow, that silver, that gold ring at the end of the rainbow. If that becomes your focus, you lose your focus on what you really need to be doing, and that is staying in your process and staying in the strategy that got you to that $8,000 in profit to begin with. If it's a mind game you have to play with yourself, that's fine. Play that mind game, but put out of your mind that you have to reach that goal, and you'll find it's going to be much easier to reach it. It seems as though when we put those goals in front of us, we push them further away. Why are we not wired to succeed at this? What does that mean? We have a tendency to create what we fear. Nobody likes to take losses. I know I don't. When I first got on the trading floor with my shiny new badge, some of the old timers said, "Hey, congratulations. Make sure you learn how to take a loss," which to me was preposterous. I'm not here to take losses. I'm here to make money. But if you don't know how to take a loss, you're going to have a long road to becoming profitable. Most of the time when somebody puts their first trade on, whether it's in a trading combine or in a live account, and that market goes against us, we start to panic. Maybe we start to panic. Maybe we just think to ourselves, or we absolutely default to the idea that, well, if I just wait, the market will come back and make me whole again, or maybe it'll make me money. So I'm not going to take this loss, even though it's small right now, and the market might be telling me that I should. I'm not going to get out of this because I don't want to establish this loss. If I establish this loss, it exists in the world and there's nothing I can do about it. So I'm going to wait. And no matter how long you wait, no matter how long you hold your breath, stand on your head, bang on the desk, or hope and pray, none of that's going to help. So what we end up doing is creating exactly what we fear, and that's big losses, because we refuse to take the losses when the market tells us we're wrong. We create big losses. And on the other side of that coin, everybody loves profits. So we have a tendency to take them too quickly. Big losses and small wins are what amateur retail traders do. Professional traders do the opposite. When you have a loss, no, first of all, you should be trading really close to the point of invalidation, or to your stop level, or where your strategy, your tools are telling you, if price advertises down here, this trade is no good anymore and I'm going to be out of it. Try and trade as close as you can to those levels to help you limit risk. Take a look at the trade. Say, we've been in an uptrend in the longer time frame. We've established a low for the day. We've looked higher. We're back near the low for the day. If I take this long and it and it extends the range lower, maybe something is wrong. Maybe something has changed and I'll need to get out of it. And then take a look at the other side of it and say, well, we've got a 40-point range in the S&P. Is I can risk 5 points on this trade. And if it does go my way, I can look at and really possibly and probably realize maybe a 20-point profit on this trade. So if I'm looking at 5 points of risk and I'm looking at 20 points of profit, I'm going to take that trade. And even if I'm only right half the time, I can build an empire that way because my profits are 2, 3, 4 times my losses. And I can be right half the time. Think about the math. So nobody likes to take losses, so we avoid taking them. We're in the trade. It's showing us that the market is telling us that the trade is wrong. Get out. Use stops. Put those stops at points of invalidation or just past. Look for opportunities that offer smaller risk and bigger rewards. And when you get that trade on and it's going your way, do your best to try and get to that profit target. If there is a profit target, if you're long in an uptrend, maybe you just let that trade play out. Maybe you just let it go. Sometimes it's very difficult to do. It's always difficult to do because we all have that urge. Well, I'm making money now. If I take it now, it's a profit. And boy, after that loss I just took, or the couple of losses I just took, that win is sure going to feel good. Man, is it going to feel good. But I just took 2 $500 losses, and this is a $50 profit. Is this really the way I want to operate? Am I operating in a manner that is in my best interest in this way? No. Look for the opportunities to trade close to points of invalidation. The market tells you you're wrong. Trade close to those. Start by looking for opportunities to take trades at 1.5 to 1, maybe 2 to 1. Maybe doing that for a while, you'll start to gain market knowledge and self-knowledge and confidence to be able to recognize when some of those opportunities might be worth even more. Try not to get those dollar signs in your eyes. So we are actually hardwired to fail at this. We don't want to take losses. We go into avoidance. We want to take profits, so we take them quickly. Learning to operate in the opposite of that, you can bring yourself a lot closer to eventual profitability and success in this. How is your brain wired to avoid risks and to pick up the $5 bill? So if you're looking down this sidewalk here, let me get this straight in my head before I start talking. Okay. And I'm standing on the side here, and in order to pass, you have to pay me $10. And then I can tell you that halfway further down the sidewalk, there's going to be $5 laying on the sidewalk every time. And then I'm going to tell you that half the time when you pass me and give me the $10, there's going to be a 20 further down the road. So when you pass me and you pay me the $10 to get past me, are you the kind of person who's going to pick up the $5 bill? Because if you do, you can't pick up the 20 the other half the time. If it were me, I would pass the $5 bill and go pick up the 20 half the time, and then come back, give you 10, go past the 5, go pick up the 20, come back through, give me 10, pass the 5, and go pick up the 20. I would do that all day long. I could make a fortune doing that. So it's a different situation. Trading is different than finding a $5 bill on the street. If you found a $5 bill on the street, you'll probably put your foot on it, look around to see if anybody's looking for it, and then you'll pick it up and go down your merry way. Trading, you're going to have to pass up that $5 bill most of the time in the hopes or in the, not hopes, in the belief that there's a 20 further down the road. And if that 20 is there half the time, you are at 2-1 reward risk. And I would take that trade every time. If it were me, I would pass me on the street, give me that 10, go pick up the 20, come back, give me the 10, pick up the 20, come back, give me the 10 and pick up the 20. Only half the time, but still I can make money that way. How do I handle emotion? Well, let me tell you, working with a group of 13-year-old boys playing baseball, we learn a lot about handling emotion. Alan sent in this email, and it was something that I said during one of the sessions created this question for him. In the last strategy session of trade management, you mentioned about a time when you were on the floor and was usually buying at tops and selling at bottoms, if I remember correctly. And yes, Alan, you did, only to see it move against you. Then one time a guy mentioned to you that you seemed to have an edge with which you thought he was trying to be funny. Now that edge he was saying was, I was buying highs and selling lows like I knew that they were going to be highs and lows, like I was trying to do that. Now he poked me in the back and said, you have no idea how good you are at this. And I said, what are you talking about? I said, if you've been watching, you've watched me buy every high and sell every low. How can you tell me that? How can you say that to me? He said, well, it's not the direction that you're good at, it's your timing. Boy, you really have a sense when this market's going to turn. And by that time, you're trying to get into a move that's already over. If you were to do the opposite of what you wanted to do, you'd be making money hand over fist. So I thought he's being a jerk, and I walked away. And I thought about it that night, and I said he was right. You know, when I have that emotion, which was basically fear of missing out, the market's moving higher. I'm thinking, man, I got to get into this because I'm going to miss the whole move. And by the time I actually get moved to reach out and buy one, I buy the high. Opposite when the market's going lower, I'm going to miss this whole move. I'm going to miss this whole move. I better do something. And by the time I would sell it, I would sell the low. So there was something inside me that was moving me to act at the right time, but the wrong direction. So I took his advice, and the next day, in that same situation, with the fear of missing out on a big move to the upside, instead of buying it at that moment when I had to act, I sold it, and it was physically painful. You think about doing the exact opposite of what everything inside you is telling you to do, and it worked. It worked, and it worked again. And it worked again. So it doesn't work every time, of course. Then you might start trying to manufacture that emotion to try and get into these trades because you think every time you have that emotion, you're changing the market. There's definitely challenges to this. But the question was, you were able to recognize the emotion was triggering you to buy at the top and sell at the bottom instead of doing the opposite. How were you able to change this behavior to do the opposite? It was, again, physically painful the first time until it worked. The next time it was a little less painful. And the time after that, it was a little bit less painful. So in positive outcomes was how I was able to change the wiring of my brain to recognize that emotion in the opposite direction of what I originally thought it was. So the last question here is, did you try to do the opposite and it worked for you without the need to actually address why you had this issue? And in essence, yes, because the outcomes were much better when I was going the opposite of the way I was being moved emotionally. It worked. Looking back at it, when we think about the retail trader, the average Joe, the trader that's just, trading an account, which at that time I was a new trader. I had a nice badge, and we spent a lot of money trying to get me in there, but I was still a new trader. The majority of the retail traders, the pea shooters like me, still, most of them are moved by fear and emotion. So if we think about what scares us, what emotion pushes us to move into the market, usually in the wrong direction, there's a whole bunch of other traders that are doing the same thing, because most of the traders, retail traders, are motivated out of fear and emotion, even if they're excellent technicians. Believe me, I've known a lot of great technicians who couldn't trade their way out of a paper bag. So when you recognize in your own fear and emotion, the fear and emotion of the others, you can take actions against what those emotions are consistently having you do, that the other traders are doing, and you can trade against them. Selling the low or buying the high means you're a laggard, means you're the last one to the party and the party's over. And you recognize that, you're going to recognize that it's a whole lot of other short time frame fear-based traders that are doing that, and you can take the opposite. Recognizing your fear and the fears of your competitors gives you an edge over them. Most people aren't thinking about that. They're not thinking about you or the community of traders in their time frame and in their knowledge base, if you will. So recognizing their fears in yourself and taking a different path from them, you're going to have a much different outcome. And when we think about the average retail trader, 90% of them are never going to make $1. If you're doing what they're doing, you can't expect anything else. Thinking about what they're doing and doing something else can greatly improve your performance. There's nothing that works every time, but recognizing in your fear the fears of the others can give you an edge over them. And that's what we're doing. I hope that all makes sense. So all of this leads into trading psychology. Trading psychology refers to the emotions and emotional state and mental state that help dictate success or failure in trading. Trading psychology represents various aspects of an individual's character and behaviors that influence their trading actions. Trading psychology can be as important, if not more important, than other attributes such as knowledge, experience, and skill in determining trading success. I am not a psychologist, unfortunately, but I have had the benefit of working with many of them. It's through that experience that I learned how important self-understanding is to profitable trading, even sustainable trading. The field of psychology is vast, and this will only maybe put a scratch on the surface of it and try to lead you in the right direction. It is only through my experience that I bring these things to you. I'm not, again, a psychologist. I would never think to hold myself out as one. I'm sharing my experience with some of the trading psychologists that I've worked with. Now, there's a number of different buzzwords that everybody talks about when it comes into trading. The ego is, of course, a person's sense of self-esteem or self-importance. When we think about ego, we think about usually somebody who really has a high degree of self-esteem, somebody who really thinks largely of themselves. In that case, you're going to have somebody who is going to be it's going to be very difficult to remain humble and understand that they don't control the market. Nobody controls the market. And then, of course, feeling like you're being threatened by something dangerous. And in a manner of speaking, we are. But the markets are never going to eat you or bite you or sting you, though it may feel like it at times. Getting a hold of that fear is going to be something that's going to be extremely important for you. There's always a degree of doubt or fear in anything that we do in trading. But if if the fear is the only thing that you deal with, then you're going to create the outcome that you fear. Greed, of course, is an uncontrolled longing for acquisition for mere material or status gain. Greed usually comes in to me when I'm in a winning trade that is nearing a profit target. When I start to see dollar signs in my eyes like, wow, this is a really good trade and it's getting close to my profit target, maybe I should expand my profit target. Most of the time, that's a warning sign to get out of the trade, because I'm starting to look beyond my strategy and hoping for a much bigger opportunity. Of course, anger, strong feeling of annoyance, discomfort, or hostility. Anger is poison when it comes to being a trader. At least from where I sit, from my experience, anger creates venom, and venom is in your veins. And that venom and that anger only affects you. When we start to get angry, we start to act emotionally. We step away from our strategy. We become somebody that we're not usually going to be. We have a little Tasmanian devil that comes out in our brain, and it causes us to act in ways that are usually not going to be in our best interest. One of my dad wisdoms from group coaching is it doesn't pay to be angry. If you're angry at a group of people, half those people don't know you're mad at them, and the other half don't care. Only person that anger affects is you. If the market has ticked you off, the market doesn't know. The market doesn't care. The only person it's going to affect is you. That's going to push you into revenge trading, over trading, getting away from your strategy. Anger is poison when it comes to trading. Anxiety is, of course, there's always going to be a degree of anxiety because we never know the outcome. But protecting yourself, using the tools to distinguish reasonable risk levels, not because we only want to lose this much per trade, but because the market dictates that if price comes down here, this trade is probably wrong, can help alleviate a lot of the anxiety. One of my dad wisdoms was preparation alleviates anxiety. Emotions, natural instinctive state of mind deriving from one's circumstances. I don't know how many times I have been at the top of the world for my trading and how many times I have believed that I am the worst human being that there could ever be on the face of the earth because of my trading. You cannot attach your self-worth, your emotion, you cannot do that to your trading. Emotions are always going to be part of trading. Many people say you should learn to control your emotions, which may be possible in short periods of time and in short time frame. I've always found it exhausting to try and do that. I found instead of doing that, I found ways to use my emotions to my advantage. I know, for example, that if I have 3 consecutive losing trades on any given day, that my switch is getting flipped. I'm starting to get emotional. I'm starting to maybe get angry. I'm starting to think about how the next opportunity that I have to get this money back, I'm going to get this money back. And it takes me out of my strategy. So recognizing that emotion has me step back, find a way to get back to center, find a way to get back to calm and in the moment, not in the last moment, in the moment now. Loss aversion. We all have an aversion to loss. Each one has a unique aversion to loss. But if our focus is on that, if that's our greater importance, if that's what we're thinking about, that's what we're going to do. And losses are always going to be more painful than any gains. It's said that a loss in trading hurts twice as much as a win feels good. Deal. I'm okay with that if my losses are 10 ticks and my profits are 40 ticks. I'll get over it. So you want to ask yourself when you're getting into trading, what is your relationship with money? When I started, my dad was a trader. He didn't, he didn't work hourly or for a salary. He was a trader. He ate what he killed. But when I got my chance, somehow I got stuck in kind of an hourly mentality. Every job I'd ever had was hourly, until I got on the trading floor. Then it was more of a salary and I was making good money. But now I'm standing there with my own business and wondering, how am I going to make money at this? Every time I had earned money, it was pretty much trading my hours for a handful of dimes. I felt like you got to dig ditches or you got to do something or help somebody else get rich in order for you to get paid, which was really the wrong way to think of it. Some people, including myself, had this idea that money was dirty and I don't want dirty money. So do I not want money? There was a situation when I was younger that there was somebody that I thought was very wealthy that was very mean to me. And, I can remember through therapy thinking, wow, if that's what being rich is, I don't want to be like that guy. Hence, I don't want to be rich. These are all things that I've personally had to work through. And I'm not saying I'm rich, but your relationship with money and how you earn money is going to be very important because this is a profession like being a doctor or a lawyer where you can work your tail off and never make a dime. We don't want that for you. So then it comes to how much do you value yourself? Once you get a grip on your relationship with money, one of the old guys on the trading floor saw my badge and said, "Hey, congratulations. Just remember, you can make anything you think you're worth." Well, that goes directly to self-esteem. And I had never had a very high self-esteem. Was always, a little heavy, never smooth with the ladies, wasn't a real pick 'em up kind of guy. So I had to deal with that. I had to learn to love myself before I could pay myself. A lot of what helped was working with 2 trading psychologists. They made me go to the gym 2 hours a day, 5 days a week. And they had spies there. They would know if I skipped a day. but I got in the best shape of my life and I felt a lot better about myself, and my trading went right along with it. Doesn't mean that you attach your self-worth to your trading, but your trading can certainly attach to your self-worth. Goes well the other way, not trying to attach your self-worth to what you make in trading. How much do you value the work that you do? Because if you're working for somebody else, you're providing value. Otherwise, you wouldn't work for them. They would let you go. Think about that. This is your own business. You have to have a high degree of the value of the work you've done to get to the point that you're at in order to pay yourself. One of the things that really kind of gets to me, especially with a lot of folks that, here at Topstep and people that I've worked with, they're so good at finding good trade locations and finding good trades and even their execution, but they're afraid of the change that becoming successful can bring. And I don't think many people actually realize this. The idea of change is frightening for many, many people. All of us, actually, especially when it comes to negative change. Nobody wants negative change, but nobody thinks about how scary it can be with positive change. I think a lot of folks will do anything that they can, whether they recognize it consciously or subconsciously, will do anything just to stay where they are. If you want to become successful in trading, you're going to have to accept the changes that may occur if you do become successful in futures trading. You're gonna, you're gonna have to deal with spouses that are wondering what's going on, or friends. Friends may, if you start making a lot of money, might say, well, he's got an attitude now because he's making all this money. And if that's the case, were they really friends to begin with? I've seen a lot of folks kind of become introverted and withdraw from people because they make a lot of money. They think that everybody wants something from them, which may or may not be true. It depends on the situation. So if you want to change, you've got to change. You got to change inside and outside to become a professional, successful trader. And you have to want that change, not just surface wise, with every cell in your body, from the ends of your toes to the tips of your hair. You have to want that change. Can you take advantage of the emotions and not run from it? That's really the question. I think, Dr. Menaker, I think, has said it best. Emotion is energy in motion. If you can't use the emotion to motivate the right moves, you're missing part of the picture. Markets are emotional. Markets are human emotion. Personal barriers, we mentioned self-worth. Fear of change, I've had it. I still have it. How much is the work I am doing really worth? If you don't have a high value on all the work that you've done to become a successful and profitable trader, you may make money, but you may be not leaving much on the table. Fear of missing out is, of course, always something. And keeping profits is directly related to everything. If you're afraid of change, if you find big profits, you're going to find a way to give them back. If you have a weak self-esteem, you may believe that the profits you've made recently are more than you are worth, and you will find a way to give them back. If you fear the change of success, you will only allow yourself to make certain amount of money, and you will give money back. think about yourself in everything that you do in trading, and where do you fit into these things? I think everybody does to some degree. That fear of success, needing instant gratification. I'm very big into that. Aren't we all, though? Wouldn't it be nice just to have a trade go from entry to a huge profit target in about 10 seconds? Well, maybe you had that happen on Tuesday with the CPI numbers, but that doesn't happen very often, and you've risked an awful lot to try and get to that. Addiction. People have fallen into deep addictions in many different things when it comes to trading, mostly talking about here the addiction to trading. If you're addicted to trading, change your addiction to your passion for markets. If you're irritable, what are you doing here? You're going to have losses. They're aggravating, of course, but if you're not enjoying what you're doing, if you're irritable, you're going to have a very difficult time sustaining and maintaining a presence in the futures industry, in the futures markets. I love what I'm doing. There are days when I don't like it so much. Believe me, I've quit a million times, especially back in the day. But at the end of the day, at the end of the week, at the end of the month, at the end of the year, and at the end of my career, I'm going to look back at it and say, what a ride. So Dr. Menaker says, we are trading our own inner market. All the beliefs and motivations in our inner market affect what we do in the outer market. This hierarchy of decision trading can help you stay in process and avoid damage. By damage, meaning there are trades we can take that are out of process that can be big winners. And those are damaging because you're going to recognize not too far into the future the same situation, and the outcome is going to be drastically different the vast majority of the time, I'm betting. So if you're looking to kind of put a hierarchy of decision making and keep a track of it, make an accounting of it, a number one trade is a trade that's in process and is a winning trade. The best possible outcome. The trade was part of your strategy and in process, and it was a winning trade. The second, an in-process trade that is not profitable. Because it is in process, just wasn't profitable, doesn't make it a bad trade. The bad trades and the most damaging ones are, of course, the one that you take out of process because you took it out of process, but it was not profitable. You got punished for trading outside of your strategy. The most damaging trade that you can take is a trade that is out of process and is profitable. We're always saying, stay in process, stay in your strategy, let your strategy take you through. I should have put a 4 here, apparently. But if it's out of process and profitable, that you're going to remember that. I don't know how many of you can agree with me when I say, I've been down $900 trading one lots and decided, you know what, I'm going to put on a 5 lot and see what happens, and ended up with a wildly profitable trade and think, wow, that was great. I was a genius. And ended up doing it again and had it and have had terrible results. Only because it worked the one time, and I'll remember that the next time. So remember, the market always looks the best at the top and the worst at the bottom. A little dad wisdom for you. That's why I was always buying the highs and selling the lows. There's a picture of my dad on the floor of the Chicago Board of Trade, probably somewhere late in the late 60s. He was helpful in helping Ralston Purina hedge their grains, because Ralston Purina is a huge manufacturer of animal feeds and consumer staples. At the time, Czech cereals were Ralston Purina. You may notice the checkerboard there. So they were working on improving the Board of Trade's view of the public. A lot of the public thought that the Board of Trade was fixing prices, which we all know that is not true. So they invited the public onto the trading floor so that they could see the process from farm to product and what it takes. And there's a picture of him handing out Chex cereals. Using your emotions to your favor, in your favor. It's a degree, it's a process of accountability. When we're thinking about impulses are created by fear and emotion. Impulses are noisy, bossy, with little or no thought, angry or vengeful. Take this trade. Take this trade. You got to take this trade. I know it's not part of your strategy, but you've got to take this trade. Intuition are feelings that are created by experience and knowledge. They're going to be much more quiet, calm, easy to miss, or well thought out. So ask yourself before you take your next trade and every trade thereafter, is this in my best interest? Impulses, fear and emotionally based responses, intuition, your spidey sense. When I was buying highs and selling lows, it was impulse. I was afraid to miss the move. Finally, I was yelled at so much by those impulses that I reacted and bought the high or sold the low. Changing those impulses to intuition through experience, I was told you should sell it when you want to buy it. You should buy it when you want to sell it. Became much more intuitive. I had to make a decision to do something different. And it worked. When you think about an impulse or an intuition, if you're walking down a mountain pass in the American West and you see something out of the corner of your eye that looks like a rattlesnake, you're going to be moving away from that rattlesnake before you even have the conscious thought, hey, that's a rattlesnake. And before you can even tell anybody else, look out, rattlesnake, you're going to be feet away from that rattlesnake. That's impulse, and that's helpful. That is going to help keep you alive. But in the market's environment, you're not going to get bit by a rattlesnake, but it can create the same pain financially. Those impulses, that fear of getting bit by that rattlesnake comes right from your amygdala, and it does not go through conscious thought. You're moving away from it before you have that thought, and that's a good thing. But your amygdala also creates fear and reaction in trading. It's a different environment, same thing. Your amygdala is there to try and keep you out of trouble. You may recognize, okay, that wasn't a rattlesnake, that was just a coiled up rope. But you want to always ask yourself, because you're not about to get bit by a rattlesnake, you're about to do something to get into something. Is this in my best interest? Ask yourself this question to find better distinction between impulse and intuition. There's ways that you can improve your accountability on that. Take a piece of paper, and when you're getting into a trade, think about what's going on inside of you, mentally, physically, emotionally, getting into the trade, during the trade, after the trade. The more you can record information about yourself inside during that trade and review that at the end of the day, the faster you're going to be able to distinguish the difference between impulse and intuition, and the faster you're going to be able to determine if what you're about to do is in your best interest. How many markets should I trade at once? I think I have succeeded in watching 2 markets comfortably. Do you think I should add a third? And to this, I would answer, what are the tools that you're using? When you think about it, every market we're trading is the same. They are never-ending 2-sided auction processes that occur in infinite time frames. Is the tool you're using transferable between products? Now, I don't really recommend trading more than one or two products at the same time, but I'm okay with monitoring 3, 4, 5, 6 markets that I would look to trade. There's so much information coming at us as traders. There's news, there's other markets, there's stocks, there's options, there's futures, there's forex, there's all of this stuff that's coming at us at lightning speed now. How much are you going to be able to digest? How simple is your process? I think, if you're adept at looking at market profiles, I think the market profiles are very transferable between products, but how much are you going to be able to pay attention to at once? So to this, I would say monitor a few, only trade one or two at once. You're going to be too distracted to notice if something changes if you're trading a whole bunch of different products. Now, I'm sure that there are those out there that can trade multiple products. That's fine. Just for me, I'm not going to be taking trades in more than, 2, maybe 3 at once. Does it cause me to miss some opportunities? I'm sure it does, but I got to be okay with that. And that's it. 1 hour almost on the nose. I hope you found it useful today. I know I really enjoyed presenting it to you. And we're going to continue to bring you more and more information and hopefully continue to see more and more of you succeed. All right. And no other questions. We'll call this a day, and you'll get the recordings one way or another coming soon. Thank you all for joining again. Hopefully something you can take with you to improve your performance in trading, even if you're an excellent trader already. Be kind to yourself. Gian, I see that there's a question from Jenner that you want to answer live.
Oh yeah, it's kind of a subjective thing, I think. In your opinion, how big would a position size have to be to move the NQ? What do you think about that?
Move the NQ how far?
Jenner, if you're still here, you want to elaborate on your question a little bit? Throw something in the chat.
I could move it 10 ticks real hard, real easy. Just buy 100 at the market. But to move the market significantly takes more bullets than I have. All right, Jenner. Thanks for the question. JD, thanks for hanging out with us today.
Always a pleasure. This was great. I hope everybody enjoyed it. Seen some great feedback in the chat right now. You should be getting another email sometime this weekend. We're doing the trading strategy courses again next week, so keep an eye out for that, and we will see most of you again next week.
Awesome, JD. Thank you very much, and thank you all for attending. Andre, your question is: what is a reasonable timeline to learn and incorporate market profile into a strategy? I've been looking at it for 30 years and I still learn more, but I don't think it takes that long. I think to become somebody who reasonably recognizes the nuance intuitively, it takes, I don't know, I would say 6 months or a year to really become kind of competent in it. There's a lot of information and a lot to know. Andre, you want to get Mind Over Markets by Jim Dalton to begin your journey on that. And I look forward to, maybe having a conversation one of these days about it with you. So trade well, everyone. Be kind to yourself, be kind to others. Keep praying for world peace. And we'll see you on the recap today at 3. Have a great day.